Hi, it's Richard Pears from FinextraTV and our Predictions 2023 series. And today I'm delighted to be joined by Richard Dupree, CEO and founder of Riskliance. How are you today?
I'm great. I'm very well. Thanks for having me.
Well, we're delighted to see you here. Two Richards, both contributing to Finextra. So, this amazing they got us in the room at the same time. But we're talking about our predictions for 2023, and specifically be interested on the fintech side of things and your experience from the US and with your world view of what's happened over the last 12 months or so and what you see going forward.
Yeah, the fintech space has been very interesting over the last 12 to 18 months. I've been involved in the space either as a risk practitioner within a fintech, consulting, but at least 5 years. And so the last 12 to 18 months have been extremely interesting. There's definitely kind of a shift. In particular, you're seeing a lot of increased regulatory scrutiny. And you see this in the US and the UK. I mean, regulators have increased their remit, whether or not that is allowed with some of the regulators, I think is up for debate, certainly here in the US. But in the last 12 to 24 months, you've seen an increased focus on NBFIs or non-bank financial institutions, including crypto and fintech companies. So you have kind of that increased regulatory scrutiny. In addition to that, you have investors wanting to see specific ROI on their compliance and risk spend. So when I started advising with fintechs, 5+ years ago, it's unregulated space, very under the radar at the time. That has changed, obviously, but back then there was very little spend on compliance and risk management. A lot of fintechs would rely on their sponsor banks to kind of define that for them. But then to execute on that from the fintech side, they would typically have to have compliance and risk staff. So they would scale up just to meet kind of the sponsor bank obligations rather than set their own strategy. And so they pivoted to setting their own strategy, which I think was a smart move. And as a result of that, investors and the board in particular are looking for specific ROI on that spend. Also, you can just Google and see increased enforcement. This comes from the increased regulatory scrutiny, AML violations. The 2020 AML Act in the U.S. Had the most significant impact of the AML landscape since the USA Patriot Act in 2001. That was 3 years ago now. That really was a game changer, I think, for a lot of fintechs, certainly in the AML space. Fraud, you're seing a lot of increased enforcements around fraud through deficiencies in the KYC program, a lack of authentication of their customers, knowing the source of funds, knowing that Rick Dupree is the actual person depositing those funds, and I'm the one generating that revenue, so I'd say that's where you have definitely seen the landscape change and just to get more challenging. And I think the shortcomings, basically I've witnessed is a real lack of clarity on the revenue model associated with operating in a financial services space. Not just on the revenue side, but also on the expense side, going back to the risk and compliance teams and not really understanding the cost associated with putting those teams into place. A lot of fintechs are still operating like startups. There's a lack of experience in the financial services space. In general, I see over-compliant and under compliant frameworks. So you have, rather than fit for purpose. So those are kind of the themes that I see driving a lot of those concerns over the last 12 to 18 months.
Yeah, interesting. And certainly I recognize a lot of that. Now, switching gears slightly and homing in on the artificial intelligence, the role of artificial intelligence in the fintech industry. A lot of people would say, oh, well, we can fix that with, quote, your AI-based tool. What are you seeing its role develop as a business and risk management tool?
So AI is an emerging tech as well as an emerging risk. Just in general, we are sitting on so much more data today than we were even 5 years ago. The cost of housing that data has gone down dramatically. A lot of companies have seen data as an asset, which it is, and have undertaken AI initiatives to better leverage that data. So you're definitely seeing, again, AI as an emerging tech. And from a risk management perspective, any type of new tech is potentially a risk to your organization. There's obviously a business benefit to it, but there is a risk assessment of that tech that you should be doing. AI is no different, but it's maybe times 100 because it's advancing so quickly. This isn't just moving into the cloud. And I remember the days of that, and digitization and digitalization, automation. All introducing those new kind of technical tools and capabilities that also create risk. If you with AI, for example, there's a lot of focus by regulators on what's called black box decision making. So if you're using data in an AI model to make some type of a predictive analysis, or that's not so bad. But once you actually kind of flip the switch and let it make decisions based on that, that's where you could start running afoul of in hiring practices, equal opportunity, as well as in credit, fair lending, et cetera. So it's certainly an exciting emerging technology, but again, and this is nothing new. I mean, just like with any new tech, you need to take a look at it. You need to see how it's going to interact with your processes, how it's going to impact your ability to remain compliant with laws and regs.
Yeah, and so I mean, would you say what are the tips you'd share? Is it you've hinted at it? It's got to be explainability. You've got to avoid the black box. You've got to what are the tips that you would recommend if people are using various AI-based tools in their organizations?
Yeah, so I think there's a lot of risk management tools. There's a lot of what companies are already doing that they can apply to managing AI. So, a lot of the traditional model risk management and IT governance approaches will get you to a certain point. I mean, they may fall short because traditional model risk management does not have the level of, does not meet the level of complexity of some of the AI initiatives. But so I think a couple of things that I've seen and recommended. But so I think effective AI risk management frameworks depend on a number of complexity of models, but should include data governance components, SDLC and PDLC controls, so software development lifecycle and product development lifecycle controls, traditional MRM components, all of that under a broader ERM framework. So start with what you have with respect to your risk management toolbox and start applying that to your AI initiatives. I'm a big proponent of a kind of a scenario or kind of what we call a new activity approach to AI. sitting in a room or getting on a Zoom with all the stakeholders, with the business, presenting, the AI use case, the ROI, et cetera, having your legal compliance and risk teams at the table, your maybe operations teams. How is this going to impact if we're taking an existing process and we're applying AI to it? How does that impact the process from a fulfillment perspective, from a customer experience perspective, and focus on that first. And you're going to have a lot of healthy dialogue around whether or not it's even worth us to kind of implement this from a business perspective.
Yeah.
Then you make that decision. Then you need to have the kind of risk and legal conversation around it as well.
Gotcha. Very helpful. And so your predictions for the landscape for the year ahead, what would you predict for us?
Well, so how about I do like a fintech one, and then I'll do a general risk one. How's
Fantastic. That sounds good.
Okay, so again, fintech space has been so dynamic and very interesting. I think, in my personal opinion, I think fintech's getting a little bit of a bad rap. I think that there is still opportunity. There's still a need for fintech companies, fintech, products and solutions. But with respect to 2023, kind of what I predict is, I'd say first probably some increased M&A activity, not only between fintechs but between banks and fintechs. I know the broader economic condition may not support that shorter term, but I do think there is. We're kind of trending towards that area. Like I said, fintech still has so much to offer to consumers of financial products. It's often easier for an established bank to acquire a technology solution rather than to build in-house. So, and in general, and that's kind of on the fintechs. On the bank side, I think in general banks have looked at fintech partnerships as a hobby. Or as a product enhancement or a way to generate more loans, but haven't really been strategic with respect to their approach. They've kind of played with fintechs, but I'm seeing a lot more strategic focus on partnerships and or acquisitions. So kind of going back, to the M&A, but certainly the partnership as well. And on the bank side, really elevating that to a strategic initiative rather than a product initiative. Another thing is in the past, 5 years or so, you've seen a trend in fintechs to obtain bank licenses. Some have pursued that route and been successful. Others have not. It's very, very difficult to obtain a charter, whether at the state level or the national level, and to put into place all the controls that are required to adhere to all the obligations associated with that charter, and then still be innovative. So you've seen a couple of fintechs or digital banks do that successfully, but at a huge cost or investment. And I just don't see that trend continuing. I think, it's a huge undertaking to kind of go that route. And I honestly, in my own personal opinion, I don't see a lot of value in starting a fintech only to become a bank. I think if start a fintech, be a fintech, work with banks as needed, focus on innovation. And so I wouldn't be surprised if you see the licensing route less of a priority in 2023 and forward.
Interesting. I want to add on one question, if I may, which is to think about. Obviously, you spoke in all of this conversation. You spoke about the increased burden of regulation and so forth, and ESG is one of those which has certainly risen in the last 5 years. And in that, there's been a demand for a lot of data. on environmental, social, governance, risk exposures for banks and fintechs. The data is obviously being looked at by things like machine learning, artificial intelligence, and yet, you know, the discount being applied to perhaps new firms, you know, in green hydrogen or whatever it might be, versus coal, is kind of skewed, and it's because one is a forward-looking dynamic data on a new horizon. The other is, you know, a lot of risk systems are based on historical data. How do you sort of see, in your view, the reconciliation of this traditional way of doing risk management and modeling in this kind of a landscape?
Yeah, ESG has presented, you know, challenges, I think, to risk managers. There's the one component of it, which is how much is my company, you know, contributing, just on the E, right? So how much is my company contributing to global warming? And there's some guidance out there with respect to how to determine that. It's fairly easy to sit down and say, here's our operations. You know, let's just say, for example, we make stuff and we ship it out. So you obviously have a carbon footprint through manufacturing and distribution, right? So that's pretty, you know, I don't say easy, but that's attainable, you know, kind of numbers. Yes. There's, you know, with respect to, you know, kind of DEI efforts within your organization, you know, how diverse is our board, how diverse is our C-level suite, et cetera. Again, all of those are numbers you could obtain, but the question becomes, how do you kind of aggregate it? How do you look at, okay, here we are as of today, but what does this metric mean with respect to how we manage risk, you know, going forward?
That's the key point, isn't it?
Right. And so, so I'm not going to say that I've solutioned for that. I think so many firms are still in that current state analysis, to be honest. And I would say, you know, focus on that, you know, kind of current state analysis just to get an idea of, and there are companies out there, quite frankly, that you can work with to help kind of get a ESG type rating or metric that your company can put into place. And then once that metric is in place, then you could assign specific goals to it. So we have a carbon footprint of X, but we want to reduce that to a carbon footprint of M, you know, let's say. And so that becomes, you know, your part of your strategy, right? Yeah. But I would look at, you know, basically indicators within your organization, where you kind of stand within each of those areas of ESG. I would look to regulation in the space. What is the expectation? What's the gap between where you're at versus the expectation? And then that should all kind of inform your, you know, next kind of strategic plan with respect to the company, where you want to head in the next 5 years. Yeah. So that's how I would recommend you approach ESG.
Amazing. Well, Rick, listen, thank you so much for getting into the Teams call today and doing this recording with me. It's been fascinating to hear your insights. And so, Rick, for now, thank you very much.
Thank you. Thank you for having me, Richard.